Thank you, Mr. Merriman. You're very welcome. Just to pick up on that point, just very briefly, I mean, the accounting standards didn't cause the crisis, but did they hide the crisis?
No.
No.
Absolutely not. And let's think about it. How did they hide the crisis?
In terms of not being able to look to the future and the potential losses.
Sorry, and let me be clear. We can all look to the future. This accounting standard over here that says you must do it this way, you must do it that way in your books, that doesn't stop me as a manager being able to say, okay, I understand the accounting standard, but this is the reality of what I'm dealing with, Mr. Regulator. Or this is the reality of what I'm dealing with, Mr. Rating Agency. Or this is the reality I'm dealing with, so I want to roll up my sleeves and hire a whole load of people who are going to help with credit recovery. The accounting standards are a complete red herring. Yes, they were unhelpful, and yes, there might have been a lag before the losses came through, and yes, that might have helped banks think they had a better capital position than maybe they had, but it's a red herring.
Okay, thank you.
In an inadequate accounting standard, but not really any material impact on what's come about.
Okay, and the fact that the Spanish banks decided to allow for cross-cyclical provisioning in their own system,
I think that's very sensible, and I've made that point in my witness statement about, there were lots of other avenues. The regulator could have come along, just by way of example, and said, you know what, we understand the accounting standard. We don't like it, and they didn't like it, and I think that, to be fair to them, they made that very clear back then, never mind since. But they could have come along and said, look, despite the accounting standard, what we're going to do is we're going to require you, the Irish banks, to have an additional capital buffer and force us to take capital in that, as you say, in that kind of anti-cycle perspective.
But you had a battle with the board about what you were reporting, didn't you, at one point?
Yeah, and again, again to make the distinction. So what was that battle about? That battle, and battle is harsh. It was a very tricky time. The facts kept on changing. The crisis kept on getting deeper. So we were struggling with what is the right number to put in the accounts. And that was back to accounting. You have to come up with the number to put in the accounts.
Yeah, but just because you go out on it in length from page 6 to 7 in your opening statement about, and you specifically say that you didn't come under any, or the only time you ever came under any real pressure or challenge on the accounts was in 2009 when reporting on the 2008 results.
Yeah.
And there was no difference of opinion between yourself and E&Y with your provisioning. But the central bank and the regulator did have a problem, though, that the provisioning might cause wider difficulties for the other banks. And we were cautioned at the highest of levels to be very sure that what we provided was really needed. So there's a difference of interpretation there in terms of the presentation of the numbers?
No, I think they're two different matters. And again, let me explain my understanding of what was going on with the regulator and the central bank. So EBS come down and we share, we're going to have our accounts, these are our provision levels, and we're sharing with the market not only these provision levels, but we're sharing with the market our expectations that there's going to be greater loan losses to come. We can't put them in our accounts, but we're telling the market that we believe the loan losses will be higher.
Yeah. On that point, other banks weren't doing that at the time.
I can't speak for other banks. Okay. But we were being very appropriate in sharing not only what we were providing, but letting everybody know we expected bigger losses to come that we couldn't provide for. The central bank, as I interpret it, their perspective, and remember, I was only having to deal with EBS. The central bank has a much wider responsibility. So they're standing back and saying, okay, here's little EBS coming along, and they're saying, God, look, we've all these problems in development finance. Shit. What's the market going to read into that? Will they read across from that into the other banks? The other banks haven't been telling us that they've got this extent of a problem. This could actually be another escalation in the Irish crisis. Now, Alan, and I'm just being clear, Alan, just be very sure you need those provisions, because this could cause wider difficulty. That's the context.
But that was unhelpful interference by that.
No, I don't think it was unhelpful.
You were trying to be more prudent or more honest, is that correct?
Look, I would choose different words. I had a responsibility as a finance director to call it as I saw it, within the rules. I had a responsibility to our members and our stakeholders to give as true an account as I could of what we understood at that point in time. The central bank has a different remit. It has a much wider responsibility. And part of their responsibility was making sure that we were taking due and proper care. So I would put it in that context. But I answered the question you asked of me in coming here about the integrity of the accounts. and I'm just being very clear, we had debate at board levels, we had uncertainty at board level about what was the right number from a provision perspective, but it never came under pressure from the board around the integrity of the accounts.
And just to clarify, you were able to call it as you saw it?
Absolutely, and we did.
Okay, thank you.
And as I explained, the reality is that in due course, the provisions that were needed were far greater than we even thought at that point in time.
I just want to go back to the time just prior to your arrival with the Society, and if we can go to the evidence booklet, volume 1, page 95, and it's a board meeting in 2002, and I just wanted, this is where they discuss at length for the whole board meeting commercial property and also the risks around development finance and the move that the board's making at the time.
What period is that, Deputy?
It's 2002. So, just to clarify, when did the EBS see it as strategically important or appropriate for them to enter the commercial lending market? You say 1991?
My understanding is they entered it in 1991, 1992.
Okay. And here in 2002, we see them talking about making a play into development finance in a particular way. If you see it in front of you on the screen.
Yep. Okay, yep.
So, what I want to understand is...
I mean, before my time, but yes, I see it.
But when you arrived in 2005, was this now settled policy for the...
Absolutely. And again, just to give, I might have some numbers here, but just to give a context. In my... Oh, look, I can't find... broadly speaking, I think by 2002, the commercial lending book was in the order of 800 million. Mm-hmm. By 2005, it was 1.5 billion. Mm-hmm. Development finance lending was clearly first done around this point in time. You can see it from the records here yourself.
Yeah.
So this was clearly an embedded strategy within EBS well before I arrived.
Yeah, so there it outlines two approaches for development finance, the go for broke or the toe in the water.
Yeah.
And the toe in the water approach is the favoured one. So when you arrive in 2005, would you still describe its involvement with development finance as toe in the water, or has it moved on from there?
No, I think, and I mean, they're very, colourful phrases that are being used. I would say that, in terms of moving from 2001, 2002 to 2005, they've clearly gone from what I'd call zero to where they had a book in the order of 100 million. Yeah. So I don't think I could describe a book of 100 million, even in the context of an EBS, as being a toe in the water.
100 million in 2005,
yeah.
And I think you said 500 million in 2008.
Yeah.
Okay.
Back end of 2008.
Right. If we move on then 2 pages to the last page of that board report, page 97, I just want to look at the last paragraph, if I may. See if it's on your screen. Is that? It's the last page of the... So it's page 97.
Yep. So just so I'm clear, the 2005 strategic...
No, it's sorry, it's not up on the screen yet. I'll just get some more time as well as a result. It's going to come up, but I'm going to read out the paragraph I'm interested in. It was suggested that, with a view to widening the base of commercial property customers, a greater level of business networking will be needed in the future. In this respect, Brian Healy will contact individual board members to establish whether they have contacts who may be a source of additional business. So, just tell me a bit about that. What does that mean? And was that practice still going on when you appeared in 2005 in the Society? And did you see it as appropriate for Society to be using its board members in that way?
What's the date of that?
It's the same board meeting in 2002.
All right, okay. No, look, I'm not. Well, let me answer the question in 2 ways. One, I'm not explicitly aware of the board being used by commercial lending in what I might call in a business development capacity. So, not familiar with that. But to answer your earlier question, do I see it as appropriate? Look, I think, what's the duty of a director? The duty of a director is a multitude of things, but clearly it's to act in the benefit of the society, of the company. So using a non-executive or any other director as a means of an introduction, I think, is acceptable.
Okay. Do you think it was acceptable for society to make that proactive approach to people, to offer them commercial terms?
No, again, look, let's be careful with wordings. I think it's appropriate for a non-executive or a director to make an introduction to a potential customer, whether it's a retail customer or whether it's a commercial customer. That's very different from saying, do I think it's appropriate to go to somebody and say, I have a bag of money here, do you want to take it away and do something with it? They're two very, very...
And you see a distinction between the two?
Of course I do.
Okay. And when you arrived in 2005, were those types of conversations happening?
No.
Still on the board? No. Okay, thanks. Well, if we could move on in the same evidence booklet, please, to page 99 through to 100, 101. And this is the commercial business plan from September 2005. You were in this society at this point in time?
Yep.
Were you responsible for developing or preparing this paper?
I need to see the paper.
Yeah. 99 is the first page of the report, and then it goes into detail in 100, 101 from there on. So that's the first, the first page is here, just in front of you.
Okay, so
And then it
again,
continues on.
so if I'm looking at, this the right one in front of me now?
Yeah, yeah.
Yeah, so, again, it's an important distinction, I think, in terms of your question. This plan would have been developed and prepared by the then head of commercial lending. So it wouldn't have been my plan, if I can put it that way, but clearly, as the person ultimately responsible for commercial lending and being a board director, clearly I would have been party to approving this plan and was comfortable with it at that time.
You were comfortable with the plan?
I was.
Okay. I mean, it notes that commercial is an area that has more than tripled in scale to about 1.6 billion of the loan book. But the problem, as it outlines in 2005, is that the lenders are lower risk, meaning good asset quality but low margins. So the desire then is to go for higher risk businesses. Now, when Fergus Murphy was before us, he said on page 61 of the transcript that the society entered into the marketplace late, and at times it tended to do business with secondary developers and investors in secondary locations, and that the society wasn't getting the better business, and maybe none of the business was good.
Yeah, look, and I think Fergus said this himself, that, because we were exiting the commercial business shortly after he joined, he wouldn't have had what I might call as granular an understanding of the commercial business as perhaps Brian Healy would have had, or indeed myself. I'll be very clear that, and let me explain. First of all, the low risk versus high risk. The commercial business EBS had at that point in time wasn't generating a sufficiently attractive return for the risk that was there. And what I mean by that is that if you have a limited amount of funding to allocate, if you're going to allocate it to a non-member business, so it's not going to your members, you're taking it away from your members to give it somewhere else, you have to ensure you're getting an adequate return. So that was the motivation for looking to move the needle on the risk curve. Fergus's comment, I would say to you very clearly, commercial was built up from 1991. I would say that if you look at the analysis that was done of the development finance book of 500 million, 70% of that business was done to established developers and builders. So I am clearly, and again, just bear in mind the context here, the total book is 500 million. So the maximum loan we might have had, and again, I'm not going to remember the exact numbers, but broadly speaking, think of it as being 50 million. If you could lend at most 50 million to a single relationship, EBS wasn't going to be in a position that it was going to be banking the glass bottle site or Balls Bridge. So clearly, by definition, we were lending our money out in the areas that could accommodate that type of lending.
So was Fergus Murphy wrong then, in that none of the business was good? They weren't getting the better business, none of the business was good. No,
look, I think, the way I'd articulate, and it's the fairest way I can possibly do it, is that, yes, EBS was later into development finance than others. Yes, it was competing in a very, very tough marketplace. Yes, it was having to establish and build relationships. Therefore, you wouldn't ordinarily expect it to have the business that would be the best business. For obvious reasons. Developers themselves want to build relationships. They want to have the confidence somebody's going to be able to bank them, etc., etc. However, having said all that, so it was a tough environment for EBS to build up that business. But it was mandated to do it. It was a strategy to do it. Now, best way of being objective in terms of answering your question, let's talk about the discounts that were applied to the books across all the banks that went into NANA and the subsequent deleveraging that was done. Fergus himself explained that the EBS discount was, I think, 57%. Big picture, that's within the goalposts of the other banks. So objectively, it wasn't much worse, than others.
As worse.
Well, it wasn't 61 or 62 or 63%. But equally, in EBS's case, the other banks only transferred loans that were greater than 5 million. There was a special case for EBS. The entire books were transferred. So you're not comparing apples with apples. And if you look at the 2.5 billion that Ferguson himself testified about, where he talked about that they had to deleverage 2.5 billion, and it ended up with a write-off of, I think he said, 500 million, the aggregate discount of those two taken together is less than 30%. So I would say that objectively the facts demonstrate that the EBS business wasn't any worse than what was being done in the market.
Okay, well, let's just look at this strategy paper, because there's 4 alternatives for going forward as they're presented. You've got hold, lean and mean, step up and rocket. So which strategy did you support?
Again, I don't have it on screen.
Sorry, it's page 101 of volume 1. It's also in your first booklet, the first green booklet, volume 1. That might be handier.
What page?
101.
The step-up strategy.
Yeah. Is that the one that you supported as well? I mean, was there unanimous support for step up, or were there different points of view?
I don't recollect the country view, and certainly I was comfortable with the step-up strategy.
Okay. The step up strategy allows for it to evolve into any other of the alternatives as circumstances allow. Did it?
It did, and well, sorry, no, it didn't. To be more accurate, clearly, and I think, look, you draw out an important point that even then there was a recognition of, let's see how this progresses. Let's see what is the obvious. This was a interim step, let's put it that way. The strategy did change, but the strategy was the exit strategy rather than a retracting strategy or a further acceleration. It was an exit strategy in due course.
Exit strategy. And about when did that change to an exit strategy? After?
I think you have, I know you have statistics that shows actually the second half of 2007, the advances being lent out in commercial and in development were tapered down, and we exited completely in the first half of 2008.
2008, first half.
So second half of 07 and the first half of 08.
Okay. Can I move on, if I may, to its page 110 in volume 1, and its board meeting in February 2009. Your candidacy for re-election to the board is evaluated, and the minutes state that you would not be invited to stand for election as a director for a second term in the interest of the society. Can you just expand on that for us, please?
Yeah, look, I think again, the broader perspective or context here is that we were just about to report our results. It was the first year that EBS was going to be reporting losses. Clearly, it was very evident that the development finance book in particular was causing significant damage. We had an AGM that was coming up in April, and there was a very strong view amongst the board that as a mutual, it was absolutely appropriate that we should be showing accountability. The chairman was going to resign, and we felt that it wasn't fair, if I can put it that way, that solely a non-executive would bear responsibility. We didn't think it made sense for wider board changes. We thought the chairman going was a clear indication of acknowledgement of the mistakes that were made, but we also felt that an executive should go as well. This led up to that, but this is more of a nuance, because this is solely dealing with the board, and Bank of Ireland adopted the same approach. Their executive directors were not put up for re-election to their board, but they stayed in their current positions.
Was it a voluntary departure then?
Yeah, no, it was fair, and I made this clear in my opening statement again today. I personally would have preferred to stay. You've heard Richie Boucher from Bank of Ireland talk about that's what he wanted to do, and he was allowed to do that. There's a natural desire to stay when one's in trouble and sort things out. But the wider context, and I was part of the board and I very much agreed with this, we were a mutual, mistakes had been made, we wanted to be different, we believed we were different, and we wanted to demonstrate that. So it was absolutely part of EBS to show accountability, and I was definitely the right person to go at executive level.
Okay, but just to come back to what's in your opening statement and some of your earlier conversation about this constant battle maybe that you were having with the board over the future direction of society and the risks it was facing, and there seemed to be disagreement there.
No, again, look,
does that play into this?
battle is the wrong word.
Okay, I beg your pardon.
Okay?
Yeah.
I was very clear that I had my concerns about the long-term sustainability for the reasons I shared earlier, capital and funding.
Okay.
That was 06, 07. The board came up with a very considered view. It went through the detailed analysis and came up with a very considered view. No, we're not selling out. We want to stay mutual. We're going to make it work. The management, we want you to make this work. You have a mandate to go and make it work. So we had that debate. I wasn't the bad loser. I accepted the board's decision. And what the strategy then was about was trying to preserve mutuality as best we could. So there weren't battles going on in the boardroom in 08. What was going on in the boardroom in 08 was making sure that the society was doing all the prudent things it needed to be doing to best protect the society at that point in time.
Okay. I just want to look at two other areas, then, if I may, in the time I have left. One is this reliance on wholesale funding, because in 1998, 100% of funding for the society came from retail deposits. In 2001, it's down to 70%. By 2008, it's 47%. Was this shift intentional? Did the board see it as a risk at the time? Did they understand the potential risks at the time?
Look, I think the start of it clearly was that wholesale funding became available to the market here. EU, Euro would have all been would have been a catalyst for that. Why did the society start using wholesale funding? Because it needed it to support the lending it was doing to its members. And then it just gradually grew over time. I think that's evident from all the papers and from the history. It grew over the course of time, bit by bit by bit. Was the board conscious of the risks around wholesale? It was conscious that there was a dependency on wholesale funding. It was very conscious of the need to diversify it. But it probably didn't anticipate, and I think this is true right across our own market, but globally, that a liquidity crisis of the type that came was as possible as it clearly was.
Mm-hmm. But do you feel
so the disappearance of a securitization market overnight would be a very clear example of that. The interbank market disappearing pretty much overnight would be a very clear example of that. Did the board did it really understand those possibilities, and did it really believe those could happen? They would have seen that as being more doomsday than being in the probable.
Okay. I have to move on, I'm afraid. I am limited on time. So the last thing I want to look at is Haven, the broker market business that EBS went into, which was a significant change for the society. Do you think the board had a sufficient understanding of what it was getting into? And how important was this move to the society, given that the CEO of Haven was also not invited to be re-elected to the board in 2008?
Well, again, the Haven CEO wasn't invited to be re-elected because at that point in time, the Haven business was going to be exited. So that was that context.
Very shortly after it had been established.
Yeah, but again, you have to look at before and after. So it was established at a time when there wasn't a funding crisis, and it was exited when the funding crisis was front and centre. The board would have done intense work around the merit of going into the broker market. The broker market typically, in a European context, is circa 50% of the market. So it's a very important part of the mortgage market. And it was done again in the interest of the long-term sustainability of this society. Broker markets bring more risks, but they were understood.
You supported the move then?
I did.
With Haven. But it was
also part of the deleveraging strategy in terms of getting. It was an answer to some of the funding challenges because there was going to be a JV at that point in time.
I wanted to ask you that actually with Britannia Building Society.
Correct.
That failed. Why did that fail?
Again, it failed. It failed for a variety of reasons, but essentially it was because, and again, look, it goes back to wholesale funding. When problems became evident in the Irish market, if you're sitting in the UK and you're building society in the UK or your local authority in the UK, you're going to be very reluctant to engage in the Irish market.
So why did EBS continue with it then? Why not take the warning signal from the failure and pull out instead of going ahead 100% on their own?
Well, because for two things. The business was already up and running, so the book that was there at that point in time was going to go into the JV vehicle, so it wasn't a case of deciding not to proceed. It was already in progress. And then we've answered your question. We did exit it.
Yeah, I mean, there was a potential sale at 1.5 billion, but that,
Question or Deputy?
thank you, but that didn't go ahead. Why not?
I told you because basically Britannia had no interest in proceeding given the difficulties that emerged in the market.
Okay.
Very much.
Thank you. Thank you.